Welcome to vTalkInsight, Market Drivers Daily for January 7th, 2026. Geopolitical fault lines from Venezuela to the Arctic are sharpening just as an AI Capex boom and stronger growth keep equities near record highs. Let's unpack how rising political risk, the artificial intelligence build-out, and a run-at-hot growth backdrop are driving today's cross-asset narrative. Geopolitics remains a structural market driver, and Venezuela is still the sharpest focal point. The latest developments reinforce a two-track story. Political and legal risk premia are rising, while the classic oil shock channel looks contained for now. In recent days, the capture of Nicolas Maduro, the installation of an acting president, and talk of deeper U.S. involvement have all underscored how central Venezuela has become to regional stability, sanctions policy, and perceptions of U.S. power. On the ground, power remains fragmented. Multiple armed groups, violence near the presidential palace, and rising political imprisonment all point to a regime that has changed its face more than its underlying structures. Press repression, including journalist detentions, adds to the sense that near-term liberalization is unlikely. Markets have reacted in pockets rather than systemically. Venezuelan defaulted bonds have seen outsized rallies on hopes of eventual restructuring, while U.S. oil services stocks jumped on the prospect of renewed access. At the same time, the U.S. dollar has strengthened as a safety valve, and gold and silver have benefited from classic flight to safety flows. The energy backdrop looks very different from past shocks. Venezuela is producing under 1 million barrels per day, down from around 3 to 3.5 million at its peak, and global oil markets are currently oversupplied by more than 3 million barrels per day into the first quarter. Restoring Venezuelan capacity would require at least tens to hundreds of billions of dollars in investment, major regulatory reform, and years of rebuilding degraded infrastructure and lost technical expertise. U.S. majors remain cautious given unresolved expropriation claims, sanctions, and contract uncertainty, even as Chevron's long-standing presence and existing license leave it relatively well-positioned. Beyond Caracas, the geopolitical map is becoming more complex. U.S. rhetoric on reasserting a Monroe Doctrine-style sphere of influence, along with talk of using force against Greenland, has alarmed European partners. Denmark's warning that an attack on Greenland could effectively dissolve NATO highlights the severity of the risk. At the same time, China has imposed new export controls on dual-use goods to Japan and retains dominance in key rare earths such as scandium. That combination is accelerating Western efforts to rewire supply chains for critical minerals, while AI tools capable of generating convincing fake images in real time add a new layer of information risk during crises. For portfolios, the main transmission channels are risk premia rather than immediate supply shocks. Gold and silver are performing well as hedge assets, while copper at record levels above $13,000 per ton is supporting basic resources and mining equities, especially in Europe. The counterpoint is that markets still appear to be discounting tail risks, from a miscalculation in Venezuela or Greenland to deeper fragmentation around rare earths and sanctions. Key watch points now include any U.S. moves on Venezuelan sanctions, clarity on legal frameworks for upstream investment, signals from Chevron and other majors, and further steps in China-Japan export controls. In short, geopolitical tension is intensifying, but for now, it is reshaping risk premia and commodity leadership more than the core global growth outlook. Artificial intelligence is still the primary engine of global equity leadership, but the story is shifting from concept to capital expenditure. Recent news reinforces what we have been seeing in recent sessions. Hardware, data centers, and power infrastructure now sit at the heart of the AI trade. U.S. AI-related Capex is estimated at roughly 38% of total corporate Capex, far above developed ex-U.S. and emerging markets, underscoring how central the theme has become for U.S. large-cap tech and the broader growth narrative. NVIDIA is emblematic of this phase. Its Vera Rubin platform is now in full production, with shipments to customers expected in the second half of the year. Management highlights up to a 4 to 5-fold improvement in training speed and an order of magnitude reduction in token generation cost versus prior generations, effectively turning data centers into far more efficient AI factories. That momentum is echoed in the wider chip complex. NVIDIA and AMD both flag a steep rise in global AI compute demand over the next 5 years. Memory prices are surprising to the upside, and semiconductor stocks, excluding NVIDIA, have outperformed broader indices since late last year, suggesting investors are leaning into the full value chain. Capital is flooding into the broader ecosystem. Elon Musk's xAI just raised around $20 billion in a late-stage round that included NVIDIA, Cisco, and sovereign investors, while OpenAI's ongoing fundraising and a potential IPO are seen as key sentiment tests for the theme. On the demand side, CES commentary and Samsung's projection that AI agents could sit on hundreds of millions of smartphones highlight how quickly AI is moving into mainstream devices. All of this is driving an intense need for power and cooling. Vistra's $4 billion purchase of gas-fired plants is one example of data center-driven electricity demand, even as NVIDIA argues its latest chips could cut data center power use by several percent, a claim that has pressured traditional cooling equipment stocks. The opportunity set is increasingly global and extends beyond public megacaps. Asian technology stocks, especially Samsung and Taiwan Semiconductor, are rallying as key enablers of AI hardware, and Asian indices have outperformed U.S. peers at the start of the year. In parallel, much of the next wave of AI, particularly enterprise software agents built on proprietary data, sits in private markets. Names like Snowflake and Databricks are cited as foundational platforms, while private credit and infrastructure financing for data centers remain robust, backed by hyperscaler contracts and recurring revenue streams. The counterpoint is valuation and sustainability. Investor enthusiasm, including FOMO-driven flows, has lifted multiples across both core and adjacent AI plays, from chip makers to data center cooling and power infrastructure. At the same time, there is rising concern that if real economic returns from this Capex wave are not visible by roughly 2027 or 2028, hardware and infrastructure names could face sharp downside. Competition is intensifying, with AMD and Intel rolling out rival data center chips, Google pushing its own accelerators, and regulatory decisions on NVIDIA's H200 exports to China set to shape a potential $50 billion market. Investors are increasingly focused on evidence of AI-driven revenue and margin gains, as well as on diversification across regions and sectors to avoid excessive concentration in a handful of names. The macro backdrop is still defined by a run-at-hot growth narrative. Despite elevated valuations and well-flagged risks, market participants remain broadly pro-risk, leaning on above-trend growth, supportive policy, and AI-enabled productivity as key pillars. Recent estimates have U.S. real GDP growth this year rising toward 2.5%, with some projections in the 2.75 to 3% range, while nominal GDP has been running in the 6 to 8% band. That combination is supporting robust top-line growth across both public and private companies. Earnings expectations are broadening. Forecasts call for double-digit earnings growth in a majority of S&P sectors by 2026, and strategists see scope for persistent double-digit EPS growth as long as nominal activity stays strong. The ongoing equity rally is no longer solely about mega-cap tech. Cyclical sectors are increasingly participating. Globally, European growth is projected around 1.3%, supported by infrastructure and defense outlays and inflation close to central bank targets. Asian equities, particularly technology-heavy markets such as Korea and Taiwan, are outperforming early in the year, helped by strong AI and memory cycles. Together with U.S. strength, that leaves global equities near record highs. Within equities, leadership is rotating. Financials, transports, consumer discretionary, industrials, and mid and small caps are all showing relative strength, suggesting a healthier breadth than last year's narrow AI-led advance. Some outlooks now point to more balanced index returns in the low double digits if growth surprises to the upside. Real assets are reinforcing the growth signal. Copper prices have surged above $13,000 per ton and have outpaced gold, supporting basic resources and mining names, particularly in Europe. Meanwhile, Manhattan office leasing has reached its strongest level since 2019, indicating a firmer backdrop for select commercial property segments. The policy and inflation picture is more nuanced. Markets are pricing a strong cyclical expansion even as some business surveys still flag macro softness, creating a disconnect between sentiment and data. Persistent fiscal stimulus, rising defense spending, and heavy AI Capex all point to ongoing demand-side pressure. Against that, there are credible disinflation forces. Productivity has been improving, unit labor cost growth is moderating, and technology, including more efficient AI chips, is exerting a deflationary influence in some areas. AI-driven productivity could allow non-inflationary growth, but also raises questions around labor displacement and income distribution that could feed back into policy. The main counter-arguments center on valuations and execution risk. Credit spreads are tight, equity multiples are elevated, and several strategists continue to flag the possibility of a 10 to 15% correction if the labor market weakens or inflation re-accelerates. Markets also appear to be underpricing geopolitical shocks, from Venezuela and Ukraine to new frictions in the Arctic and Asia. Supply-side constraints, including limited copper availability, electricity bottlenecks for data centers, and political resistance to infrastructure expansion, could cap the pace of growth. Key indicators to track now include labor market data, inflation prints, earnings revisions across cyclicals and tech, copper, and other industrial metal prices, and the breadth of equity and private market activity. Together, they will show whether the current run-at-hot thesis is sustainable or due for a reset. To wrap up, geopolitical risk is clearly rising, but an oversupplied oil market and a strong growth backdrop mean the pressure is showing up more in risk premia and commodity leadership than in a classic macro shock. The AI investment cycle continues to intensify across chips, data centers, and power infrastructure, offering powerful growth optionality, but also heightening valuation, concentration, and execution risks if economic returns disappoint. At the same time, a run-at-hot growth narrative with broadening earnings support and cyclical leadership keeps risk appetite elevated, even as inflation and policy paths remain finely balanced. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.